back to EDS, and in this video I'm going to show you step by step the best beginner friendly options trading strategy. This is suitable for beginners. Even if you're experienced, you'll probably still learn something. Whether you've got a small account, large account, this is going to benefit everybody, but especially if you have a small account, especially if you're a beginner, this video is for you. So the first thing that we want to do is go over what it is that we're going to be doing. How does the strategy work and what makes it good? Okay, so we're going to be using two instruments here, two vehicles, and one is going to be futures contracts and one is going to be options contracts. Specifically, we are going to be writing the options contracts on the futures contracts. Now, it might sound complicated, but in practicality or in practice, it's not that difficult to do. So the reason why we use those two things is because when we write options contracts, it allows us to create a high probability of success, which is very good if you're a beginner. It means you don't need to worry about losing trades too much, and it's very good if you have a small account as well, because you don't have to worry about losing trades too much. And the reason why we use futures is because futures margin requirements are calculated using span margin, which means it allows us to be very capital efficient, and again, that's also very good for smaller accounts. And if you have a larger account, it just means you're going to be able to get a higher return on your money. So what we want to do is pull up a watch list of futures contracts that have options available to trade on them. So if your broker doesn't already give you a pre-made watch list, just take note of these ticker symbols here and you can make your own custom watch list. And then what you want to do is rank or list the watch list from high to low IV rank. And the reason why we do this is because we are going to be writing the options contracts, which means we're short the contract. And whenever you're short something, it means you're selling high, buying low. And volatility plays a factor on option prices. So when volatility increases, option prices increase. And we want to be selling high, buying low. So we want to sell when volatility is high and then play the contraction of volatility back down to the mean and further below. That will be good for our P&L on that position. Now, one of the reasons why this works is because volatility is mean reverting. Another reason why this works is because implied volatility is generally overstated compared to actual volatility. Okay, so anything with an IV rank of 30 or higher is considered to have a high IV rank, and anything with an IV rank of 50 or higher is considered to have a very high IV rank. I'm not sure why I just had to put my password in again there, but there you go. So 30 or more. And I generally like to be anywhere in and around the mid to high mark. So anywhere between 30 and kind of 60, 70. I kind of get a little bit nervous if an IV rank is sort of over 100 or something like that. That's not to say that you can't trade it, but it just means that the market is expecting a big move in that particular underlying. Now, when it comes to choosing which particular underlying that you want to trade or which futures contract that you want to trade, if you have a smaller account, you'd probably want to stick to currencies. So for example, we've got the Aussie dollar, the euro, the Canadian dollar, the British pound, the Japanese yen. If you have a larger account, feel free to just go with whatever you want. But generally speaking, currencies are more suited for smaller accounts. So whichever contract you choose, it's all the same process anyway. So we're just going to focus on currencies in this example. So let's just say, for example, if we take the Canadian dollar with an IV rank of 42.9 and it has an absolute IV level of 8.2%. Okay. Now, you might be thinking 8.2%, that's quite low. Currencies generally do have a low IV, and that's absolutely fine. Span margin takes that into account, and it means that we're going to be required to have less buying power to open this position, which is why it's good for smaller accounts. So what you want to do is, once you've selected your underlying, you want to pull up the list of expiration dates for that particular underlying. Now, on the left, we've got the option expiration dates. Then we have the futures contracts, which we'll go over in a second, and then we also have how much time is left on the options contracts, not the futures contracts. So every good broker will automatically integrate options and futures contracts together like this. So for example, because remember, futures contracts have an expiration date too. So February 7th, March 7th, those two options expiration dates line up with the 60H5 futures contract. April 4th, May 9th on the option side of things lines up with the M5 futures contracts, and so on and so forth. Now, you don't really want to worry too much about the exact specific futures contract, whether it's H5, M5, U5, or whatever it might be. As long as you have a good broker, it'll automatically line them up side by side like this, or display it, in however they display it. But the point is, it'll be integrated for you, like in something that looks similar to this. And what that means is it allows us to only have to worry about the options expiration date. So the one that we want to pick, the expiration date that we want to pick needs to be between 30 and 60 days out. So if we look here, we've got one here that's sitting at 45 days out, which is absolutely perfect. That's right in the middle, and that's exactly what we want. So that lines up with March 7th. So we're going to open up the March 7th expiration date, and now we can see the options change. So just to quickly explain what's going on here, on the left we've got calls, on the right we've got puts. We've got a horizontal orange bar that shows us where the price of the Canadian dollar is with respect to our strikes here. Going down the middle is all of our strikes, and we have this vertical orange bar that shows us what the expected move is of the Canadian dollar futures contract over the next 45 days. These dotted blue lines show us where our standard deviation levels are. We also have delta here for our calls with positive deltas, and we have our negative deltas for puts on the right hand side as well. So two things, we want a high return on capital, and we want a high probability of success. Now we're going to get a high return on capital because we've selected futures, and so now we just need to focus on getting a high probability of success. So when we are writing options contracts, what that basically means for us in practical terms is that whichever strike we choose, or whichever strikes that we choose to write our contracts at, we want price to stay away from those contracts. We don't want price to breach those contracts or those strikes. We want price to stay away and out of the money. Okay, so there's three things that we're going to use to ensure that we get a high probability of success. One is the expected move. So if we want price to stay away from our contracts and we know what the expected move is, then logic will tell you that you want to be writing your contracts at strikes that are sitting outside of the expected move. We also, so with that in mind, just one other thing, the further out you go, the higher your probability of success. However, the less premium you collect and the lower your return on capital. So in order to make sure that we don't go too far out, I personally like to use standard deviations. So we want to be in and around the one standard deviation mark, and everything should also line up nicely with the deltas as well, and it should land anywhere in and around the 15 to 20 delta mark. So outside of the expected move, in and around the one standard deviation level, and in and around 15 to 20 deltas. So if we start off with the call side, we have a 17 delta here. If we sell that contract at the 0.715 strike, and then we do the same thing on the put side, 17 delta, sell that contract at the 0.68 strike. As you can see here, our two contracts now, we've got one call and one put. Our two contracts are sitting at the 17 delta on either side. They're sitting outside of the expected move, and they are in and around the one standard deviation level. Okay, and as long as you follow these 3 points of confluence, your position will look something like this every single time. All 3 points will pretty much line up every single time. So what is now happening? So what we've done is we've created a range for ourselves. So remember, we want price to stay away from our contract. So what we want to happen over the next 45 days is for price to stay within this range. Price can go outside of this range if it wants to, but as long as it's inside this range at the point of expiration, we're going to keep 100% of the premium that we collect up front, which we're going to discuss in just a second. So what's the likelihood of price being within this range at 45 days time? Well, we've got a pop here, and pop is probability of profit in the bottom left corner. Now, pop is basically your probability of making at least 1 penny on this trade, and that is currently at 70%. Okay, now if we have a look, we've got at our strikes, we've also got the green bar here. Okay, the green bar shows us where our break-even levels are, because our break-even levels extend beyond where our contracts are. And the reason why is because the premium that we collect up front is non-refundable. So once we collect it, no matter what happens, we keep it. Okay, so our break-even points would be whatever our strike is, plus or minus the premium that we collect, depending on if it's a call or a put. If it's a call, it's plus. If it's a put, it's negative. That's why our break-even bar slightly extends where our strikes are, and as you can see, it overshadows the expected move, which is good for us. So our pop is basically telling us we've got a 70% chance of price being anywhere along this green bar at the point of expiration, which is in 45 days time. So straight away we've got a 70% probability of success. Okay, now what if we don't want to wait all the way to expiration? What if we want to get out at, say, 50% of max profit? Well, we have a P50 here, which isn't displayed for futures. However, your P50 is typically 10 to 15% higher than your pop. So your P50 levels are going to be between 80 and 85%. So we've got probabilities of success of between 70 and 85%. Anything over 50 is considered high probability trade. So we've got a very high probability trade here that we're looking at. Now, what's our compensation on this trade? So if we look here in the bottom middle, this is our mid price. This is the price that we would be looking to get filled at, 0.0034. Off the top of my head, I believe the contract multiplier for the Canadian dollar futures is 100,000. However, for every futures contract, it is slightly different. Futures are much bigger products than equities. Just to keep in mind, so to give you a comparison, an options contract on an equity controls 100 shares of the underlying. In this instance, it's 100,000. It goes even higher than that for some futures contracts, but you don't need to worry about what the contract multiplier is, because your broker will automatically calculate it for you. So your mid price multiplied out by the multiplier on the contract will give you your max profit. So this is the actual premium in dollar terms that we collect, which is 340. So as soon as this trade gets filled, $340 will get added to our cash balance in our brokerage account. Okay, and our broker is going to require $525 in buying power to open this position. So we're going to collect 340, and it's going to require $525 to be tied up. And as you can see straight away, this is a very high return on capital. Okay, if we were to work out exactly what that is, we would do 340 divided by $525.18 multiplied by 100, which gives us 64.7%. So we've got a 64.7% return on our capital, and we've got probabilities of success of between 70 and 85%. Okay, it's this simple. Right now, that doesn't mean that you just full port and you just put all your money into one position. Right, we're going to get into a little bit more risk management in just a second, but in a nutshell, in essence, this is the core fundamentals of how you craft these positions to give you high probability of success and high returns on capital. You do need to keep in mind that futures are large products, so you do need to keep your risk management in check. You do need to know how to manage your risk. You do need to know how to make adjustments, etc., which we'll talk a little bit about towards the end of the video. And there's just one other number that I want to discuss with you here, and it's theta. Okay, and theta on this position right now is $10.25. So what that means is, assuming all things are equal and stay equal or the same as what they are right now, every day we'll get a daily theta decay of $10.25. And remember, we're short the contracts, we sell high, buy low, and theta decays away at the value of the contract, provided that the contract is out of the money, in which this instance it is. So what that means is that every single day we're going to get a daily P&L on this position, positive P&L of $10, and it's changed just now, but $10.26 as of right now, assuming everything else stays equal. Now, as we get closer to expiration, data decay becomes more aggressive, so that number will increase, assuming all else stays the same. So keep that in mind. Data decay is working in our favor. Just as we move through time, we get paid for it, which is another very, very good benefit as to why I like to write the contracts and sell them as opposed to buying them. Okay, now just a little bit more about risk management. You do need to keep in mind how much buying power you are allocating to your positions, and in order to get it right, we've created a free position sizing template that's available for everyone to use. Link is in the description. Just click the button on it and it will take you over to the spreadsheet. The way it works is you enter in the size of your portfolio. So let's just say if you have a small portfolio of $5,000, you can then enter in whatever the current VIX level is. Let's just say if it's 42.6, I wish it was, but it isn't. And then everything will be automatically calculated for you. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general, the minimum amount of your portfolio that you should be allocating to undefined risk trades. Undefined and naked positions are the same. What we went over today is a naked or undefined position. It'll tell you everything about how to structure your portfolio, and as long as you follow this and use this as the backbone, the guideline of your portfolio, you'll be absolutely fine. If you do have a very small account, you may need to just tweak the numbers a little bit and be more aggressive just because it's a smaller account. However, just try and stick to this as best you can. If you have a large account, you definitely should not be breaking any of these rules here, and as long as you do that, over the long run you'll be absolutely fine. And if you want to learn in more detail about what we do and how we do it, click this button here. Link will be in the description. Click on EDS Premium, get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, which is very important. And it shows you everything in real time. So it's full transparency, full access. There's a full course as well, so no prior knowledge is required. We'll go through everything in detail, start to finish, about what you need to do and how to do it. If you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals, and there's a 100% money-back guarantee. So once you've studied the full course and followed some of our trades, after 6 months, if you have not been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free, and right now it's $9.99 a month to join. The price will be going up. However, once you're in, the price is locked in for you for life. So the earlier you get in, the better your price will be, and you are rewarded for getting in early. The price is going to keep going up. For every batch of members that join, the price is going to go up and up and up and up. But whatever price you get in at, it's locked in for you at that price. So the earlier you get in, the more you're rewarded, basically. And the aim of EDS Premium is to teach you the skill. It's to get you to a point where you know what to do, you know why you're doing it, you don't need any external help or influence. We're not trying to keep you dependent on us for the rest of your life. We're trying to give you the skill so you can take it with you forever, and no one can ever take it away from you. You can use it for the rest of your life, and we aim to get you to a point where you're completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community. However, within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.